Thinking as a long-term investor, which is what you do, if the markets aren't free.
The thinking or the long term?
Thinking as a long-term investor.
Yes.
Which is what I think of you as.
Thank you.
How do you invest confidently if it's not a free market?
Well, I think the answer is, well, first of all, our investments are not driven by the macro, and we're not macro investors, and we're not Fed watchers, and we're not economists. We are micro investors. We invest one company at a time in companies where we feel we are well paid to take risk, and where we think the outcomes are predictable. So in general, Eric, we don't make judgments about that, about the macro. You know, it's very easy to make those judgments. It's hard to make them correctly, and it's harder still to have the events you predict materialize on time. And when they don't materialize on time, you get into trouble. And I think that, you know, you can name on just a few fingers the people who are famous for getting macro right. I think of trying to guess at these things as an opportunity to make mistakes. There are a lot of people who went to cash at the beginning of this year and thinking that there was a lot of uncertainty and low prospective returns, and that prices were high, all of which was true, and they missed a lot this year. And so I think getting in, getting out, very, very challenging, not something we do.
Is there a moment when it's appropriate to get out of the market, in your words? And if so, when might that point be?
Well, there is, I think, when there's a demonstrable bubble, and when psychology is crazy bullish, and the risks are extremely high, and valuations are extremely high. Implicitly, I'm saying I don't think that's today. I think things are elevated to the point where you have to proceed with considerably more caution than usual, but I do not think that we are in a dangerous bubble.
What might the next dangerous bubble look like? You know, when do those valuations reach the nosebleed level that drives you out of the building?
Well, I mean, for example, we don't manage money in the mainstream stock markets.
Right.
But in the S&P, you know, the PE ratio is about 19 today versus the post-war average of 16. That's a little high. In 2000, it was 32. That was a bubble. And so I think that bubbles are connoted by extremely high valuations, and also by bubble thinking. And bubble thinking says, for example, nothing bad can happen. There's no price too high. This can't lose. Now, those things sound nutty, but I've seen them several times in my life. And we've seen bubbles ranging from the nifty 50 bubble, in which IBM, Xerox, Kodak, Polaroid, Avon, Merck and Lilly, and et cetera, were selling at 80 to 90 times earnings in 1968, 69, to the tech stocks and the internet stocks. You know, in 1999, people said, you know, the internet will change the world. This is an internet company, so consequently, there's no price too high.